All set? All right. I'm going to call the meeting of the City of Worcester Trust Funds Commission to order. Today is February 26th, 2026. My name is Paul Foley. I'm the commission chair.
Shepard Allen, trustee.
And if the other folks around the table wouldn't mind just introducing themselves for the record.
Francisco Hernandez, Treasurer and Collector of the City of Worcester.
Tim McGurthy, Chief Financial Officer for the City of Worcester.
Brian Gemros from Bartholomew and Company.
Kathleen Zaganowitz from Bartholomew and Company.
Thanks. Our first item on the agenda today is I have the Trust Fund Commission meeting minutes from December 11, 2025. I have reviewed those meeting minutes as drafted, and I'm going to move to have those meeting minutes approved. Is there any discussion?
No discussion.
Do I have a second?
Second.
All those in favor say aye.
Aye.
And that gives us our first agenda item. Our second agenda item is a presentation of the 2025 year-end status by Bartholomew and Company. And I'm going to turn the microphone over to our representatives from Bartholomew and Company.
Excellent, thank you. It's good to be back. Last time we were here was December 11, 2025. We went through the 9/30 through the 9/30 2025 performance. Today we're going to go through from 9/30 to December 31st, 2025. Here with me is Kathleen Zaganowitz. And we're going to go through this review. And my understanding, we're also going to go over some of the inactive accounts and kind of start discussing some of the opportunities for that as well, correct?
Yeah, that'll be the next agenda item after we finish the review for year end.
Excellent, excellent. So without further ado, let's dig into the review. Just bear in mind some of the, well, actually, we'll just dig into the review. So everybody has a copy of this about the company, and I'll just give you the quick rundown. I guess this is more for the new people. Bartholomew and Company, as of December 31st, 2025, we're about 5.7 billion assets under management, 3.3 billion in assets in the municipal institutional space, which represents about 330 municipal entities. So we have a whole department primarily dedicated to municipal entities and endowments and trust funds like this, okay? Kathleen's been on this team. I know you haven't met her before. Alex has primarily been out here. Kathleen's been on the team for the last 10 years. Prior to her being as an advisor on the road, excuse me, a little dry, right? This time of the year. Prior to her being an advisor on the road, she was a director on the internal investment management team. So she'll be a great compliment today, okay?
Terrific.
Okay. Let's get, you don't have to worry about the bios and all that. And one thing I do want to talk about is, in the past, before we get into this, if I could, just a little housekeeping. In the past, this is by your previous board, you've asked for this detailed, economic market update and performance report. Is this something you still want to see, or do you want to just get to the performance numbers and go through the economic and, we'll always give you an economic update, but on a quarterly basis when we send you the reports, would you just like to see the performance? Or would you like to see this complete package as it is presented today?
If at the next meeting you want to provide examples of both so that we can, compare and contrast what they might look like,
Sure.
That'd be fine.
Okay, we can do that. Excellent. I'm going to turn it over to Kathleen. We're going to dig right into, we'll give a market update if we could. We'll start with the market update as of, giving an update since 9:30. Okay?
All right. So in your packet here, we have, in our typical fashion, probably way too many charts, but I'll kind of touch on just how we view the market right now and maybe skip over some of them, but we can always come back as well. So from a high level, starting with the labor market. So really, we feel right now that from a labor market perspective, unemployment's quite low. There's been low hiring, low firing. So you're seeing a little bit more balance, a little less activity. Someone in our office called it kind of a boring labor market, which is actually okay. I think that that's a positive sign. I think it's what the Federal Reserve is looking for. We're just looking for essentially not a crash in the labor market or some sort of extreme movement. So even a little bit of an increase in the unemployment rate would actually be fine. So really, job creation's continued, participation has stayed the same relatively. So overall, from a labor perspective, things look quite good. I think going forward, you're seeing, post-COVID resurgence of jobs. You're definitely starting to see some slowing or maybe future demand for labor starting to decline a little bit, as I said. But that can be a good thing. It can reduce some of the wage pressure, which contributes, of course, to inflation. So the two things that we look at and that the Federal Reserve looks at is labor and inflation. And so if those things, yes, they can soften a little bit, but again, as long as there isn't an extreme change in either of those things, we feel pretty good about where labor and inflation are at this point. Skipping a couple of slides, we, again, inflation, you can see here, I know not helpful for anyone watching this, but just from a high level, inflation has been very uneven depending on what part of inflation you're looking at, but the overall direction has been down, which is what we're looking for. Food and energy prices always tend to be volatile. Housing inflation has been the real big pressure on inflation, but that should start to decline. You're already kind of seeing signs of that, which is great. On the flip side, there could be some price pressure with tariffs, of course, some kind of unknowns here. But again, just from the data that we do have, things, still, they're headed in the right direction, really. Federal Reserve policy, just quickly in terms of where interest rates are. So similarly to the labor market and inflation, we're kind of headed to a more normal stance by the Fed. So the expectation is that they'll cut rates one more time this year. I've seen some, like JP Morgan, for example, they think that they won't cut rates at all this year. So of course that all depends on the economic data, but I think it's a positive sign that where we are, we maybe just want to stay the course. And again, make sure nothing dramatic changes. So that's some of the view on the Fed policy. I think where we're most concerned comes down to the consumer. So you have a couple of slides here, and I'll just talk briefly on these. Spending has been really solid, which is a huge component of GDP, right? Consumer spending is 70% of GDP, but you've started to see personal savings rates come down, disposable income rates come down. You've seen credit card delinquencies on the rise, student loan delinquencies, auto loan delinquencies starting to rise. So from a consumer perspective, a little bit of a decline, which makes sense. After COVID, everyone was flushed with cash, and now those things have started to play out. So again, something we're keeping an eye on. It matters. How consumers feel, how much money they have, influences behavior. And so again, we don't want to see a dramatic change in that case, right? And then kind of if we skip a few pages here, we have a slide on artificial intelligence versus the market. So we'll talk about this more, I think, as we go into the performance. But we've gotten a lot of questions about this, and so really the biggest driver in the market as of late have been those technology AI types of names. They've really led the market. Like I said, we'll talk about that a little bit in your portfolio. And so that's the high level. So I guess the bottom line for us is we feel actually fairly good about the data that we do have. I think obviously there's geopolitical risks going on. There's a lot of things that can change, a lot of uncertainty. there was data we didn't have because the government shut down. So there's some cracks in there, but I think we overall feel fairly good. That can always change tomorrow, but that's how our team feels for now. Let's going into the portfolio. Do you want to start?
Sounds good.
Okay.
Any questions on any of that?
No, I don't think so. I think, yeah, well, let's get into the portfolio review. Shepard, I don't know if you have any questions on the general outlook.
Not right now, no.
Okay, excellent. We'll just stop us along the way. So as of 12/31, we're going to dig right into it. Trust fund portfolio review. After that Callan chart, next page. The trust fund portfolio review on page 1 of 9, 12/31/2025. The ending balance as of that date was 18,000.
18.
I'm sorry, 18. Sorry, forgive me. I look
Just
at
for the record up there, like,
Sorry, thank you. 18 billion, no. 18 million. I looked at, what I did was I looked at the thousand mark initially. So 18 million, 2979.22, okay? Sorry about that.
no,
I need lunch and need a little lunch for protein. Here we go. Okay, the next page, 2 of 9, given a slide deck. This is our sand chart. This is how the portfolio has been invested since inception, since 3/6/2017, and you can see the various colors on the bottom of the chart represent how much equity, domestic bonds, international bonds, and you can see that shift. On international equity. We've had international equity on that top, which is the yellow, right about somewhere between, basically in fiscal year 23, we exited out of the international equity based on the investment policy mandate that the board required, and that you'll see as a portion of the portfolio of underperformance on some of the benchmarks, unfortunately.
Yeah.
International equity, has lagged for many years, and of course, right after we got it out of the account, it did well.
Yeah.
So you're going to see underperformance throughout that.
Right.
That's going to be a common theme and through to this date. and
Sure.
age, okay. Let's go through on the bottom page, 3 of 9. If you cut that page in half, 7/1/2025 through 12/31, the first 6 months of the fiscal year, you're going to see the beginning balance started at 16,904,661.08. At the end of the day, there was contributions of 80,885.78, withdrawals of 110,686.20. There's not much interest in here because the type of investments. So we're going to get dividend and cap gains. That's what you're going to see your increase. 377,130.09. Management fees for that period of time, 16,617.88. The ending balance, correctly this time, 18,209,79.22. Total gain after fees is 1,128,118.56.
do you know what the contributions of 80,000, do you know what that relates to? I'm just curious.
I can find out. I have to
Okay.
look into it's a contribution for one of the trust funds. It could
Yeah.
be cemetery perpetual care, it could be sale of lots.
I believe those are the donations for Hope Cemetery.
okay.
Thomas said,
So we had additional donations into that fund?
yes.
Oh, great. Okay. Terrific. Yeah.
Through the chair, that's true, because also the Worcester Education Fund, people contributing through their taxes, they can volunteer to contribute to certain funds. So it's probably limited to a very few specific funds that are actively receiving revenues on an annual basis.
Sure. Okay, great.
And Francisco can always get you, or we can get you all the details of each
Yeah,
one.
just a point of interest, so.
Absolutely. Would you like that for the next time, or would you like us to? I can give
Yeah,
it
it
to
wouldn't
you.
be a bad idea. I mean,
Okay.
that'd be helpful. Yeah,
If you want, I could, when I turn it over to Kathleen, I'll take a look at it and give it to you now.
Sure.
Okay?
that sounds great.
Okay.
Thanks.
Okay. So as of time weighted return for that 6 months, 6.66. Take a look at the left side. This is going to be since inception. Left side of that same page, since inception. I'll just keep it high level on this side, but I always like this report because, how much, you always look at the high water mark and then you say, oh, well, it came down a little bit, but what is the actual numbers? What I love about this report is it tells you the total contributions of 11,563,000, just rounding, withdrawals of 902,000. At the end of the day, your total gain for that period of time since inception, which was 3/6/2017 through 12/31 of 2025, you're at a 7,341,587 total gain, or annualized return of 6.30.
Yeah, just for the record, the date of inception is the date, I think, that we started working with Bartholomew. and
Correct.
Company. Yeah.
Yeah, we would only carry the performance through the time you worked with us. Otherwise, we're going to have to go through the, we don't have that performance, unfortunately. But that's a good point, Paul.
Yep.
Thank
Yeah.
you for bringing that
No,
up.
of course, yeah.
Absolutely. Very good point. On the bottom side of this half page, you're going to see the brown line, which represents the contributions or withdrawals out of the account, and the blue line, which is going to represent the market values. So you can see it's been pretty constant between your withdrawals and your contributions, keeping pretty steady. But the market value has gone up. So going to the next slide, page 4 of 9. We've moved from fiscal year to a calendar year report. Let me just point something out. Well, actually, this is calendar year report, because this report is through 12/31. So your one-year number on your portfolio return, that's going to be January 1st through December 31st, okay? If you see this report any other time during the year, it's going to be the last 12 months. So just be mindful of that, okay?
Yeah.
But in this case, since it's 12/31 numbers, we're looking at a 10.86% return. The benchmark at 16.12, that underperformance is primarily related to the international equity.
Okay.
Okay? Anything you want to add to that, Kathleen?
No, that's
Okay.
great.
It's going to give you the 3-year number, 11.94, return average, 5-year 6.70, and since inception of our portfolio, since we've managed it, 6.30. Down to the next page, 5 of 9. I always like this, calendar year return. Take a look on the left-hand side. You're going to see calendar year by calendar year. This portfolio, it's nice to see double-digit returns in the last 3 calendar years. Don't always expect that. You're going to see in 22 negative return. Everything was negative. Equity, fixed income, the only thing you could have done well was in cash. But if you invested in cash, that was the only year, and you would have had to time the market. So
Yeah.
that's no good for this portfolio because they're long-term funds. So the average, they're just giving you the numbers a little differently. Okay?
Sure.
Next page. I'm going to have Kathleen go over all the holdings while I dig into some of that information I promised you.
Okay.
Yeah, so just, as a reminder, as Brian kind of alluded to, we removed international equity, but here you can see your total balances of each of these asset classes. So when it comes to domestic equity, just about 50%, a little over 50% of the portfolio is in domestic equity. You have, and then on the alternatives side, so alternatives, just as a reminder, my easy way of saying it is, right, it's anything that is in a stock or a bond. But here you have a couple of funds, for example, things like commodities. So that top one that you see that says Managed Futures strategy, that's essentially a basket of commodities, so things like oil, coffee, it could be different currencies. So really those investments are there to behave differently than the rest of the market. I'm sure that Alex and Brian have talked about this, but when markets are down, we expect the alternatives to help a little bit. So when the Russia and Ukraine crisis broke out, the only investment that was positive was your Managed Futures portfolio because it had that oil exposure. So it's really there to just help smooth out the ride over time. Okay. And then for domestic bonds, you have about 32% in domestic bonds. We haven't changed a whole lot here. Treasuries have paid quite well compared to the rest of the market. So we've had a lot more kind of what we would call plain vanilla types of bonds when we can make, 4 or 5% on treasuries. That seemed very like easy guaranteed money to us. So we had, quite a bit in there, but there's some diversification, some corporate bonds, mortgages. Again, we like to keep things very diversified because these are long-term funds, right? So we want to make sure we can have some good risk-adjusted long-term performance. You have one small exposure into international bonds, just about 5.5%, and then the remaining on that page 7 is just cash. We don't keep a lot of cash. Obviously, we want this to be invested unless you need money. But everything here, these are all liquid mutual funds, some ETFs in there as well. Any questions on any specific holdings? You know, I would say to, and again, I'm sure you've heard this, but we as discretionary managers, we're in here making changes along the way. So we follow your investment policy, of course. But you know, the investment team will go in and say, okay, do we want to own, for example, when it comes to large cap equity, I talked about AI. So that's really led the stock market performance, where these large cap growth types of companies. And so I know you're looking at 1231 here, but in January, the investment team said, okay, let's sell some of that back, just in case there's a reversion. You know, we don't want to be over allocated into 7 companies, right? So they sold some of that down, which was good, because actually in January those were down a little bit. So we're in here making adjustments on the margins. I'm sure you've heard us say that before, but I think it's important because I don't want you to think we just kind of sit your portfolio and never do anything with it, especially when you see some of these purchase dates. Some go really far back, some are more recent, but we're in there rebalancing and making some, you know, active decisions. Now
Okay.
I'll pause.
Sure.
If there's any questions
No,
on
no.
any of that.
Shepard, do you have any questions about the investments themselves?
I think on a portfolio scale, like, is there a targeted, because we are using income as our primary source to be funding, is there a targeted, like, 30-day SEC yield rate? And then I guess too, like, do we know, like, the overall average cost of funds within the portfolio too? Those would be like 2 questions. That I have.
Yeah, so I'll answer the cost one first. So we could do an analysis, so I can get you the exact number. But in terms of underlying expense ratios for all of the funds, my conservative guess is 70 basis points.
Okay.
Could be a little less than that. I just want to be conservative.
Yeah,
we
and
can follow up.
I think follow up would be great.
Yeah.
Just, I think.
Yeah, we don't have a report that shows that, but you're right, it's an important question because that comes off the performance. But I'll have them really look at the underlying and let you know.
And then I guess too, like, just because we are relying on income to fund projects,
Yep.
like if I don't know if you have a targeted, or if it is in the investment policy statement, a targeted, like, total income yield on the portfolio, or like what the total income yield on the portfolio is. It looks like 2.25-ish, just off like back of the napkin math, but that would be great just to see as well.
We can do that for you.
Awesome, thank you.
Any other questions? Sorry, any other questions? I'm like, I didn't.
No, no other.
I just had a question just on the AI exposures. Like, what do you see in the year ahead in terms of, I know that there's been massive investments in AI technologies, and from what I read in the papers, and I'm no investment guy, but it seems like folks are hoping that at some point those investments are going to start to pay back.
Yep.
Do you have a sense as to like what sort of timeline we're looking at for those investments to start paying out? Or, I mean, when do we start getting worried about the overinvestment in AI technologies and whether or not that's actually going to pay benefits?
Yeah, so I think we don't have it in here, I don't think, but one of the pieces we're looking at is productivity gains. So I think a lot of what people are worried about is job losses and, you know, does that ultimately really help a business if they lose their people? And so you've actually seen, I wish we had it in here, but maybe it's a future chart, but you've started to see already some productivity gains in the economy attributed to AI. I think my opinion, and Brian can chime in on this too, when we're looking at investing in AI, you don't know which of these names will survive. And so it's kind of like, you know, 2001, the .com. Obviously the internet is great, but a lot of those things, a lot didn't work out. And so, you know, that's our concern, I guess, here is we would rather be invested in the companies like NVIDIA, for example, you know, that take advantage of AI and use it for their business processes rather than the AI companies themselves.
Okay.
I think, though, that will change in the future. I think there will be more household names that's what they do is AI. So I don't know if I'm answering your question exactly. I think we're still very early in seeing the benefits. And then, of course, there's, you know, the other side of the issues, energy issues and things like that come to with AI. But that's kind of a fluffy answer. We just don't. We're in the very, very, very beginning.
Yeah, we don't want to take a chance on picking the wrong company.
Yeah.
So we're looking at companies that are investing in AI technology to make better productivity so that the bottom line is enhanced.
Okay.
Does that make sense?
It does. Like you're looking at productivity, you said, as one benchmark to see whether or not that side of the equation is working out. Are there any other benchmarks that you're sort of keeping track of? Like, does it even make, and I'm just throwing out questions just to throw them out. Like, do you look at, I'm assuming some of this is based on lending to, you know, these AI companies. Are we looking at default rates there? Is there any marker for that? Or is that just all very much private equity, not really?
Good question. A lot of it's private
it's
equity.
private equity.
Yeah, so you can't really track.
And we don't have any of that in here.
In
Yeah.
this portfolio, no.
Okay.
Right, yeah, so, right, and Brian, I mean, you've talked about this coming from the banking side. Well, I'll let you say it, because I don't
No,
wanna
you say it,
offend
because I don't know where you're
bankers.
going.
No, you know, to get a real loan from a bank, they want to see certain things, and I think a lot of those, you know, AI is still something not maybe bankers are super gung-ho on, and so that's why they're getting those.
Oh, the conservative
the
approach.
lending
Sure.
They like to see a flow of
private-
funds on the bank.
Yeah, yeah, they like to see
Maybe
a
a tangible
collateral,
asset every
a
once in a
tangible
while.
asset, yeah, no offense to, you know.
Not taken, I just wasn't sure where you were going. So.
But no, so that's why, my point is, so much of it is on that private side, yeah.
Yeah, okay. As a commission, do you think it's right for us to be a little bit concerned about that aspect of the market and just how over leveraged maybe folks are in that sphere, or?
For this portfolio?
Yeah,
No.
okay.
Not
So
in
you
this
feel like we're pretty
portfolio.
well diversified? Okay.
Yes.
Definitely,
All right.
yeah.
Would it, to the chair, would it be helpful to have like a sector breakdown so we could kind of see, like maybe against a benchmark, like
Yeah.
a lot of, like I think the Russell 3000 was in here, but then we can kind of see, you know, how much exposure we do have,
Yeah.
and that would help us kind of maybe ask good questions too on, I think, a lot of value-oriented companies.
Yes.
It looks like.
Well,
we're-
right, I was just gonna say that as well, in terms of your large cap value, you have about 41% of the portfolio is in large cap value, 7% is in large cap growth, and then you have some small cap growth in there. So you'll definitely see you have far less of that basket than the broad market. We could show that for comparison. We have access to all that.
If that's
Yeah.
something you'd
Yeah.
like to see.
Yeah, I mean, it could be helpful, yeah. Just for, I mean, I don't think it needs to be a regular part of the report, but maybe at the next meeting, it might be a good thing for us to be able to see.
Yeah,
Sure.
sure.
Yeah.
Yeah.
Sorry, we're adding to your shopping list.
No, I think it's
We
fun.
work for
I
you,
like
whatever
it.
you
I
want.
think it's
We're
great.
trying to trim this down and we're adding pages.
Please hear me clear. I'm just trying to make sure we're not, giving you what you don't want.
Yeah.
We'll give you whatever you need, but
Yeah.
if you're not looking at any of this, we don't want to just waste your paper. or
No,
your
of
time,
course, yeah.
Right?
Yep.
That's all that was intended for.
Yep.
Getting back, just real quick on the contributions on that question that the chair had, Paul.
Yep.
Is, in the first quarter, there was a Hope Cemetery, $43,326 contribution to the principal, which is probably sale of a plot. And then Hope Cemetery, again, $36,979, which equals to $80,305. So that's your $80,000 contribution.
Okay.
And most likely sale. There's a couple of small ancillary, 120, 200, but
Yeah.
for the most part, that's your 80,000.
Okay. Yep, that adds up. All right, that sounds great.
And I would assume that is because it's gone towards principal, it's a sale of a lot, because half of that, or whatever your policy is in that place, when you sell a lot, half of it goes to non-expendable,
Yep,
and the other half goes to sale of lots. And that, the sale of lots goes to your general fund, which you don't even get involved with. That's for digging up the grave, burying the grave, putting the grass and all that.
Yep.
The non-expendable portion really goes towards the portion by the trust of the state that is dictated by your cemetery commissioners, that difference or that spread or that percentage, what goes in where. And you can never touch the non-expendable of that.
Yeah.
You can only touch the earnings.
Of course. Yep. Yep. We get it all here at the Trust Commission. Everything from the heights of AI to the depths of grave digging. So,
There you go.
We've covered it.
What else do you want to know? Does that help? Any other questions on that report?
no, I think that's great.
Let's talk about
Was there
life.
anything else about your quarterly review that you wanted to go over, or
No,
are we at a
that's-
terminus on that?
I think that's a good overview.
That's a good overview.
Yeah.
And any more questions from my other commissioner?
No.
Okay. Anything from the city on the, okay, all right. Our next item on the agenda is going to be the discussion of fund investment strategies. So let me preface this a bit. Shepard, you're pretty new to the commission. From time to time, the Trust Commission revisits its funding strategies and its investment policy. We adopted a new policy in June of 2024. I don't know if you've been provided a copy of that.
Don't believe so.
It makes for riveting bedtime reading, so
Sure.
I think,
Put you right to sleep.
you should get a copy of that. I don't know if the city should certainly provide you a copy of it. Yeah. I think the last time it had been done, I want to say was 2013 before this, but I could be wrong about that. So I won't go through obviously the entire investment strategy right now. One of the things that you've heard in the presentation is that I think as part of that investment strategy that we adopted in 2024, we were advising the investment advisors to get us out of international equities. Based on what we're hearing, obviously that's something that the Trust Commission could revisit. I don't think that's the purpose of today's conversation, but it's certainly an aspect of the investment strategy that could be revisited at any point in time. But one of the other things that we have been grappling with as a commission is that maybe you've gotten a little bit of a flavor of this at this point. We have a variety of purposes. You know, each of these trusts are geared toward a specific purpose, and some of those purposes are more active than others. So every May, you are going to see and then vote on scholarship funding for the Worcester Public Schools. We get a fairly large number of requests for those kinds of funds. As a commission, we have to obviously look at the funding request, make sure that it's drawing upon a trust fund that in fact is for that purpose, and then we look at whether or not there's enough money in that trust fund to fund the request as submitted. But what happens a lot of times is that you're going to get one trust fund or another that's hit over and over again year after year, and those are what we would probably call active funds, meaning we're funding requests out of them pretty regularly. The problem with that, obviously, is that there isn't as much income in those funds as there are in some of the what we would call more dormant funds. So the discussion that we want to start to get into today, I don't think we're going to come to any kind of a conclusion on it, but the conversation that we want to start having, and which we've sort of been having actually now probably for a year and more, is can we get to a place where certain dormant funds are held and invested in a certain way and active funds are invested another way? That's on the investment side. On the commissioner's side, it's our job to properly communicate to the people that are requesting funds, letting them know, okay, if you're coming in for a scholarship this year, this scholarship fund really doesn't have enough income. You're going to have to look elsewhere to get that need met.
Yep.
It's what I call crop rotation, basically. Like they've really got to go from one
Yeah.
plot to the next to get the yield that they want to get out of it.
Yeah.
So, with all that as the backdrop, somebody has given us a spreadsheet. Was it you?
Through the chair, yes. What you have in front of you is the current 12/31/25 status of the various trusts, as well as the spending from each trust over the last 10 years, to give you a sense of what funds are active, what funds are dormant, and where the funds stand at the current time.
Yeah. And then just for the record, obviously, this is categorized by the categories of each of the funds. You can see the first page is health and code related funds. The second page, this is the City of Worcester's hospital.
Through the chair, yeah, and I don't know the history, I don't know if Bartholomew does, but the trusts that are under the Trust Fund Commission are grouped.
Yeah.
There are 5+1 groups. And so each collection here is a grouped set of trusts that are generally, in the beginning cases, fall under the same guidelines. They are part of the cypre. They have similar purposes. As you get to groups, let's see, group 5, there's group 5 school and group 5 various. Those have independent purposes which are listed adjacent to each group or trust name, the gift number, then the purpose of the trust.
Yeah. I can speak to the cypre. I mean, just by way of history, at some point in time, the city had a City of Worcester hospital, and that hospital since went defunct. But for a long period of time, people had been establishing funds or donating money for the benefit of that hospital and its various purposes. When that hospital then was no longer existing, the city had to file what they call cypre petitions to the courts to have those trust funds reallocated to other purposes. So what you're seeing here is kind of a summary of those court actions and what those funds can now be utilized for that previously had been dedicated to the City of Worcester Hospital. Again, as you can see from the first page, these are what I would call largely dormant funds. These are not being utilized. You can see you got zeros across the board from 2017 to 2026, with the exception of the Clarendon Wood Fund. The next page, the cypre funds, also a largely dormant category of funds with a few exceptions. The group 4 additional cypre funds, also entirely dormant from 2017 to 2026. And then you get into the school funds, which you can see are not dormant. These are pretty active. And you can see on the right-hand column that the ending earnings can be pretty low in some of these instances, and fairly robust in others. But those are the concerns that we have as a trust fund commission. And then you have other dormant funds on that next page in terms of the police department, the parks department. And then you have the final page also has a fairly healthy number of what I would call dormant funds. Shepherd, do you get all that as a
Yeah, no, this
by way of intro to the topic and backdrop?
Yep,
All right.
all good.
All right. So, I guess the question to the group, maybe starting with Bartholomew and company, is, in your experience, you guys deal with a number of municipalities. You guys deal with a number of different city trust funds for various purposes. Is this a scenario that you have seen in other municipalities, where you're going to have funds that are more actively drawn upon and funds that are more dormantly drawn upon?
Yes.
Okay. And
The answer is yes, sorry.
okay, great. No, I appreciate that. And in your experience, is there certain strategies that you've seen implemented to deal with that situation?
Yes.
All right.
Yeah, you can, yes.
Okay.
We can get into more detail when you're ready.
No, no, and
Yeah.
that's my second, I'm doing cross-examination here,
Okay,
just
I
so
like
you, just so you know. So can you talk us through some of the strategies that you've seen implemented and what you've seen working and not working?
Sure, absolutely. So once you separate, and this is the first point I was going to tell you. Thank you, Tim. This is great. Look at the last 10 years and see which, on your GL, which Tim has nicely presented in a large format so you can read it. And the nice
He's very
part-
mindful of our age, so, you know.
Yeah, which is great. What's nice about this is once you have these funds separated and you can kind of take a look at them and take a deeper dive, this is the first step. Figure out which ones are inactive or dormant, whatever you want to call it.
Yeah.
And, make sure why are they inactive or dormant? Look through that. Is there something that, people are not aware of that this could be, one of the departments could utilize? Or just, there's just not enough money in there to spend. However, let me just go back to a couple of things you can do depending on the types of funds they have. Let me just see something. I just want to look at something here. I mean, I would want to dig into, some of these have some good ending earnings balances. Why are they not being used?
Yeah,
You
sure.
know, Is it, I don't know, in a minute, we've seen it where, somebody from the school, I'm just making up stories right now, looking
Yep.
at yours, but somebody from the school retired, they handled it, they did all the scholarships. They left, and now it's not being done anymore for the last 10 years.
Yeah, sure. Yep.
Or, somebody left ABC department, and they were doing it, and they had a passion for it. What happened? Why did those stop? So that's the first course of action that I would take, is find out why they're dormant. See if you can look at any history and see why they're dormant, because some of these have some good some good money. In tight times, people could be looking for some of this funds.
Yeah, no, I'm going to use that as kind of a jumping off point. Again, Shepard, I'm sort of trying to give you a little bit of a tutorial. I think I've made this point before, but it's great that we have all this money. But that's not the point. That's not why
Yeah.
these people who are now deceased put this money aside. They didn't put it aside so that we could clap each other on the back and say we've got 18 million. They put it aside because they wanted it to be used. And so I think as a commission, in the last year, we've probably made more of an effort on the outreach side. But certainly, Brian, your point's well taken that, dormancy is not ideal. Activity is ideal, and hopefully healthy activity. But okay, point taken. Obviously, as a commission, we've got to do a little bit more on the outreach side. Just so you know, I think you were here for the last meeting. After you left, we had a number of submissions come in from the Board of Health, which were unique, first-time
time ever, I
submissions.
heard.
Yep. So that was very fun. That was one of the funnest meetings I've had as a commissioner, to be honest. But yeah, understood. Certainly, we got to attack the dormancy issue at its roots. So take us from there.
So if I were you, what
Yeah.
I would do is I'd see if we can get this from Tim in Excel spreadsheet format, make it ascending to the largest dollar down to the least amount, and start tackling the top dollars, if I was doing it personally. I mean, you don't have to do that, but I'm
Sure.
thinking,
Yep.
let's take a look at that, okay?
Yep.
And find out why, I would, how many are there? 10 out of the, I'm not sure. How many, I'm just making up a story here.
Yep.
Out of all these dormant accounts, maybe there are 10 that are over 25,000.
Sure. Well, yeah,
You know,
at a minimum, yeah.
Let's look at that. That's
Yep.
what I would do. First, take that at large dollar value, and I would take the ending earnings. Don't necessarily look at the principal, because the ending earnings is what you can spend.
Yep.
Just remember that, and that's if you're looking at our accounting reports in this package, just remember, which is very similar to the ending earnings, and it matches to the penny, because you have a great financial department making sure they're squaring up the books on a quarterly basis. But when you're looking at, if you're ever looking at I'm only pointing this out because there's a common error here. When you're looking at this accounting report from us, if you're looking at that, which is part of your package, just be careful to look at the ending earnings as well. Just hone in on that, because that's what's on your GL over here. That's what's expendable,
Yep.
the ending earnings. Some people start looking over at the market value. Just be careful with that, okay?
Yep. Understood.
Okay. Just because we have Shepard being relatively new, I'm just trying to point that out.
Yep.
Okay, then I guess what I would do from there is figure out, take a look at the top ones.
Actually, sorry, Brian.
Yeah, go ahead.
You're going to add this to your shopping list. You could actually do that report for us if you wanted to, because you've got all the funds here. And I think you could just tweak your spreadsheet so that we had it categorized by ending earnings, right? mean,
Help
if you-
me out, help me understand.
Yeah, yeah, if you took that column that you were pointing our attention to,
Yes,
and then this was the whatever.
that's your expendable portion.
Yeah, if you went from highest to lowest with this column, you know what I mean?
The only problem is, I don't have the last 10 years, this is in your GL.
Oh, yeah,
That's why I didn't do that.
yeah, sure, I get
Because you want to see the GL and what the expenditures were,
Yep.
in my
understood.
opinion.
Yep,
I mean, certainly I could do that for you, easy enough.
yeah, yeah, right.
But you need this, is this easy enough to do, Tim? I'm sorry.
Through the chair, we can do that with this spreadsheet as well.
Yeah,
That's not-
okay.
Yeah, just because you really want the last 10 years of activity.
Yep, for sure.
I don't have that.
Yep,
I mean, I only have through 2017.
yeah, yeah.
So that's why I pointed to that.
Yeah, if we can get a report that shows ending earning, if we can sort of isolate dormant accounts and then ending earnings balance, and then active accounts ending earnings balance, maybe that would be a good way to kind of go about it.
And then from there, we can take a look at what are your goals for those funds?
Yeah, so let's break that out a little bit. So what are the goals for funds that are dormant versus what are the goals for fund? I mean, am I thinking about that correctly? Like that we should have a goal for dormant funds and a goal for active funds?
So the answer is yes.
Yeah.
You know, if your goals for your active funds and you're not meeting, you're not trying to achieve, you're not achieving enough return on your investment portfolio, we can ratchet up the equity exposure to target a higher rate of return
Yep.
to target what you're trying to spend out. Does that make
Yep.
sense?
It does.
Because right now you're at a 60-40 portfolio.
Yep.
And if your active funds you're not making enough money based on your goals or what's set forth, we
Yeah.
need to ratchet up that equity exposure.
Okay. Go ahead, Shepard.
Yeah, one question. For the ending earnings, are those being moved to a separate type of account that's invested differently?
No.
So they're still subject to market fluctuations, but it's earmarked. Do you ever see municipalities segment those funds so that they are maybe more conservatively invested than the other portfolio?
No, not at all.
Okay.
No.
So-
What you're seeing in our report too, just for the record, is there, if I could, if it's okay.
No, go ahead, yeah.
You're going to see market value and you're going to see book value.
Okay.
And you're going to see the book value is going to be typically substantially lower than the market value because they've been in here for so long and they've been dormant. and
Yeah.
So, go ahead.
So in your experience dealing with other municipalities, when they look at, different strategies for dormant versus active accounts, can you tell us what you have seen and what you've seen work or not work, and then what the risks of that are? I think is obviously a related point.
Sure. So typically, broad brush strokes, and chime in anytime. The dormant ones typically are because they're just so low value. You know, you're not making much on a $5,000 account in income.
Oh, sure.
And so what would be appropriate for that is to ratchet up the equity exposure. So you can get some growth on the account, and then you could spend that money 10 years from now. You know, on a $5,000 account, if you have a 60-40 portfolio and you're trying to grow that account, well, you're going to do it, but it's going to take a lot longer.
Okay, so
So
that's
increase the
interesting.
equity exposure.
Yeah, so on smaller dormant funds, you're seeing folks ratchet up the equity exposure? Okay,
We would,
yep,
and that would be our recommendation.
okay. Then talk to me about larger dormant funds. I'm assuming in those situations, you're trying to sort of protect the equity that you've built up, or?
Goes back to the first question I had.
Yeah.
Go find out why.
Right, yeah.
Go find out why. Did somebody
Yeah.
retire? Did somebody leave? I
Yeah.
mean, we find that treasurer changes. We didn't realize they were the head of this committee as well, and they were the one that took care of it.
Yeah,
Well,
Yeah.
nobody conveyed. I mean, I'm not talking about the city of Worcester. I'm just talking in general.
sure,
They didn't convey that to the new treasurer.
yeah. But looking, and I look at that as the spending side of it, but looking at the investment side of like a larger dormant fund, I guess my question is, you mentioned obviously ratcheting up the equity exposure smaller dormant funds, and then I'm assuming that the corollary to that is that on larger dormant funds, you're gonna take a less exposed approach.
So that's going to be depending on, so the larger dormant funds, if there's no need to spend, we're not going to take the equity exposure.
Yeah,
We don't have to.
yeah,
You know,
yeah,
if you're not going to do anything with it, why take the exposure?
yeah, yeah.
So really, I think once you dig into it, you're going to find some good source for that money to be used.
Okay, does that kind of, and Shepherd, feel free to jump in with any questions you have, but does that, is there anything else on dormant funds that you would sort of want us to be, you know, cognizant of, or strategies that you've seen? And because now I'm gonna jump into active funds, obviously.
I can't think of anything. I mean, it's, you know, I can't think of anything at this point.
Okay, all right,
Kathleen, anything? No.
all right. So, on active funds, similar approach? Are you looking at larger active funds versus smaller active funds, or a totally different approach altogether in terms of investment strategy?
So yeah, we're not necessarily looking at the dollar value as much as we're looking at we're looking at the dollar value, and we're looking at what percentage of the target return you're supposed to give out, or you're targeting to give out.
Yeah,
You want to go over that formula?
Yeah,
kind of-
so with the active ones, we would like to look at something like this and see as a percentage what you are spending and what you would like to be spending.
Yep.
Because it sounds like there could be a difference depending on what we're talking about. And so from that perspective, so let's say, you're spending, we look at it from a total value perspective too. So not just the earnings. What we would want to see is what are you spending of the total principal or ending value of each of those line items. So let's say you're spending 3%.
yeah.
For us, the simple math is, okay, we need to obviously make 3%, accounting for inflation. So we want to make another 3%.
That's a big account.
Yeah, that's a big account. We'll say 3%, and then we want it to grow beyond that, at least 1%. So in our mind, we have to target 7% return for whatever, if that's what that is, if that's the goal, is to spend, that 3%, you want it to be more consistent. We've seen, different communities, whether it's scholarships or libraries, that want to be able to give a more consistent figure. They'll kind of, in some cases, ignore what each year's earnings were. They'll want to see more of a smooth percentage that can look back at the last, we call it trailing quarters of the last 5 years,
Yep.
where we're looking at average balances, taking 3% of those average balances, and then, kind of going from there for what our target is from an investment perspective. I kind of talked about that in a backwards way.
No, that's okay.
But for the active funds, that's what we would want to know.
Do you think you have the data in front, and I don't mean to put you on the spot,
Yeah.
but, and if you need to throw a shopping list back at us, give it to Tim.
Yeah, well, this is awesome. I like that all the purposes are there, because that's, I think, for most, especially smaller towns, they don't even know what the purpose is.
We don't see this. This is
So
great.
that's,
Oh, good, okay.
That's a huge difference. So you have what you've been doing. I guess my question would be, first, kind of what you were saying earlier, is this what would be consistent?
Yeah, I think you
Okay.
can take that as consistent.
Yeah.
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 I mean, I think amongst the commissioners, we're hoping that some of these funds become more active, but let's just assume for purposes of this conversation that what you get is what there is, and probably what there's going to be. So if there is additional data that you might need, obviously let us know that, but I guess my ask would be that we set up another meeting, obviously, but that you might come back to us with an analysis of the active funds and a suggestion as to what a target, might look like. Then the question becomes, as a commission, here's how I see it, and I could be wrong about this, but this is how I see it. I'm not the investment guy. You're not the investment guy, and we don't want to be. And by the same token, they are, and they want to have, obviously, the flexibility to invest things the way that they see appropriate. But they want to understand from us, what our aspirations are. I think the end of the day deliverable is that, we sort of convey to them, this is what we think are dormant funds, this is what we think are active funds, and now, here's a possible target. I think that's our deliverable. I mean, is there anything outside of that that we need to convey to you all?
Could I ask a question
Yep.
about that? So is the ultimate goal then maybe for separating the funds? So I guess my question
Yep.
around that is if you have dormant funds that you want to start having be active funds,
Yep,
in theory, these lines are going kind of from account to account?
yep,
Okay. We can definitely do that. I just would say, we can do all this analysis, actually. We can do different scenarios, but because I'm on the investment side, and maybe this logistically doesn't make sense,
yep,
to me, the dormant funds are benefiting by being dormant in a account where they're making more earnings.
yep,
So I know that, logically, if you want some of these to sit and not gain or lose money, that's fine. But they are, for all the time that they've been in this fund with the active funds, they have built up these earnings, which has benefited them. So I just
Yeah.
say that just we can absolutely separate them. But I guess I'm just thinking.
Yeah, let me, I didn't give this update to Kathleen when we looked at this
okay.
in the past. I apologize, my fault.
No, it's
When
good.
we looked at this in the past with this board, we actually established a new account. We had a new account established, we were getting ready to move forward, and then we had a turnover of treasurers,
yeah.
unfortunately.
Okay, oh, great,
And then Tim became the treasurer, and then,
yep,
so I think this whole process was started back several years back, but unfortunately, there was a turnover in treasurers.
yep,
But the intention was to open a separate, at the time, the heart of the board was to, from my recollection, was to open a separate account,
Yeah.
take the dormant accounts, the lower valued ones, actually, we didn't define that back then.
Sure, yeah,
That I
yeah.
can remember. We just assumed they were lower dollar values, but we didn't
Yeah.
have this report in front of us. We ratchet up the equity exposure so we could put that money to work and then use it hopefully in years to come.
Yeah.
So that was kind of
Okay.
the sentiment.
yep.
Yeah. So
And certainly our intention is not to take, dormant is only as to expense, dormant isn't as to investment.
Right.
We want these things to grow.
I guess, Kathleen, one thing you brought up, like if there's a blurry line on a fund that's dormant becoming active, does that create a challenge for you guys as far as like the transition from dormant to active, if we have different allocations, or is that still pretty easy to kind of manage and move around on your side?
It could, we can manage it. We can manage whatever
Okay.
you want. Yeah.
I think how I see it is I think we need to look at, the detail falls on what Tim has presented to you today,
Yep,
and to look at, those top, however many accounts they are,
yep,
dig into what is there.
Yep.
And then look at some of those, why aren't they being used? And then really, we may end up with 3 accounts. I'm not sure.
sure.
Right.
We're not there yet, though, I don't think. I think after we do some analysis and homework, we can then have a better conversation.
Yeah, I think that makes sense. Okay, is there anything else you think you need from us to kind of dig into that?
No, we can look at this and see what our recommendation would be. Yeah.
Yeah.
From at least on the active side, obviously.
Sure.
Yeah.
Yep, okay.
Yeah.
What do we have, on the GL, does it have the expenditures for the last several years too, Tim? Yeah, this is, okay. Could we have that as well as an Excel spreadsheet? Is that okay? No, I mean in a formula, sent over to us in an Excel? Okay. Email so I can manipulate it. Thank you. Look at that, just ask and you get it. Thank you.
That's it? That's how it is around here. Just don't ask us, because we're useless.
Not useless, just different
We
perspective.
can't even talk offline. It's,
Oh, right,
I
right,
know,
right, because you only have 3.
I have to pretend like he doesn't exist when we leave this room. That's the way it works.
I mean, I try to avoid them at all costs. So this is good.
So it's-
That's for other reasons.
Other
Matt.
reasons.
This is a safeguard. I can't talk to you.
So Shepard, you kind of gotten thrown into it here.
No, this is-
Before we depart this topic, is there any other questions or concerns you had?
No, this is great. Thank you guys as always. Super professional, and this is fantastic. So really enjoy the packet and everything you guys bring to the table. So thank you.
Thank you.
I don't have any other items on my agenda, so I'll just ask if anyone else has any other items of business to discuss, other than our next meeting scheduling, which we don't necessarily have to do right now, but
With Mallory not here, it might be easier if we do it.
that'd be fine. Yep. Okay. With that in mind, I'm going to move to adjourn. Do I have a second?
Second.
All those in favor say aye.
Aye.
Aye. So adjourned. Thanks,
Thank you.
everyone. Yeah.
Yeah,
Appreciate
quorum
it.
with the 2